Did you know that a whopping 54% of bachelor's degree recipients graduate with student loan debt? A staggering 92.78% of the $1.76 trillion national student loan debt comes from federal loans? Let that sink in for a moment. More than half of the young adults walking across the stage at graduation are also stepping into a world of debt. And the majority of this debt is not from credit cards, personal loans, or even mortgages. It's from federal student loans. Now that's a lot of late-night study sessions and instant noodles, isn't it? Now you might be thinking, okay, so student loan debt is prevalent, but what's the big deal? Well, the magnitude of this issue is immense. It's not just a few hundred or a few $1,000s we're talking about here. The national student loan debt is in the trillions. Yes, you heard it right, trillions, with a big, bold, capital T. Student loans can be complex creatures, but they primarily come in two forms, federal and private. Federal loans, as we've just learned, account for the lion's share of all student debt. They are loans provided by the government, and they come with their own set of rules and benefits. On the other hand, we have private loans. These are offered by private lenders like banks, credit unions, and sometimes even schools themselves. They're like the mysterious, lesser-known cousin of federal loans, making up a much smaller portion of the overall student debt pie. But here's the catch. While federal loans may make up the majority of student debt, this doesn't necessarily mean they're the bad guy. And conversely, just because private loans constitute a smaller slice of the pie, it doesn't mean they're the good guy. So how do you navigate this world of student loans? How do you make an informed decision about which type of loan is right for you or your loved ones? Well, that's exactly what we're here to explore. With these alarming statistics, it's crucial to understand the differences between federal and private loans. Let's proceed. Diving into the world of federal loans, there are four types: direct subsidized, direct unsubsidized, grad plus, and parent plus. So let's take a step into this vast ocean of federal loans. We'll start by exploring the first type, direct subsidized loans. These are the chameleons of the loan world, their main feature being that they adapt to your financial need. The government pays the interest on these loans while you're in school at least half time, during your grace period and during deferment periods. It's like having a financial safety net while you're focusing on hitting those books. Next up, we have the direct unsubsidized loans. These are the independent souls of the federal loan family. Unlike their subsidized siblings, these loans accumulate interest during all periods, even while you're in school or during grace and deferment periods. These loans are available to both undergraduate and graduate students, and you don't need to demonstrate financial need to apply. Now let's talk about grad plus loans. Are you a graduate or professional student? Then, these loans are for you. They're like the big brothers of the direct, unsubsidized loans, offering higher loan limits. However, they do require a credit check, so make sure your credit score is in good shape before applying. Last but not least, we have the Parent Plus loans. These are for the parents of dependent undergraduate students who need a helping hand with education costs. Just like the Grad Plus loans, these require a credit check. So, moms and dads, make sure your credit history is as clean as the room you wish your college kid would keep. All these federal loans come with fixed interest rates, which means no surprises. The rate won't change over the life of the loan. And let's not forget the default repayment term of 10 years. It's like a decade-long commitment to investing in your future. But remember, with great loans come great responsibilities. It's important to understand the terms of your loan agreement before signing on the dotted line. The silver lining? Federal loans offer more borrower protections and generous in-school repayment options. But what about private loans, you may ask? Well, hold on to your hats, we're about to dive into that next. On the flip side, we have private loans, which make up a small part of the student loan market. Now you might be wondering, why is that? Well, let's delve into it. Private loans are provided by banks, credit unions, and other financial institutions. Unlike their federal counterparts, they're not backed by the government. This means that the terms and conditions can vary widely, depending on the lender. First off, let's talk about the borrower requirements. Private loans have stricter eligibility criteria compared to federal loans. They typically require borrowers to have a good credit score and a stable income. If you're a student with limited credit history or income, this could be a potential roadblock. But don't worry, there's a workaround: a co-signer. A co-signer is someone, usually a parent or guardian, who agrees to repay the loan if you can't. They essentially vouch for your ability to repay the loan, and their credit score and income are taken into account during the application process. While this may seem like a big ask, it's a common practice and can often help you secure a loan that you wouldn't otherwise qualify for. Now let's talk about interest rates. Private loans can have either fixed or variable rates. Fixed rates remain the same throughout the life of the loan, while variable rates can fluctuate based on market conditions. The latter can be a bit of a gamble, as it can lead to lower payments if rates go down, but higher payments if they go up. It's also worth noting that the interest rates on private loans can be higher than those on federal loans. This is because private loans don't have the same government backing and borrower protections as federal loans, making them a riskier proposition for lenders. Repayment options for private loans are often less flexible than those for federal loans. Most private loans require you to start making payments while you're still in school, and they don't typically offer income-driven repayment plans. However, some lenders do offer grace periods and deferment options, so it's important to read the fine print. So, you see, private loans come with their own set of challenges. They require a good credit score, stable income, and often a cosigner. Their interest rates can be higher, and their repayment options less flexible. But despite these hurdles, they can be a viable option when federal loans don't cover all your educational expenses. Private loans may seem less appealing due to their stricter conditions. However, they can be a viable option when federal loans fall short. It all boils down to understanding the key differences. Now that we've unpacked both types of loans, let's pit them against each other in a showdown. Grab your popcorn, folks, because it's time to get down and dirty with the gritty details. Let's talk about the 6 key differences between federal and private loans. And trust me, these aren't just any differences, they're game changers. The first one on the list, borrowing limits. Federal loans have set limits. For dependent undergrads, the total limit is $31,000, while independent undergrads can borrow up to $57,500. On the other hand, private loans are like the Wild West of borrowing. They can cover up to the total cost of attendance, which can be a blessing or a curse depending on how you manage it. Next up, qualification requirements. Federal loans are like a friendly neighbor. They don't care about your credit score or income. As long as you're a U.S. citizen or eligible non-citizen, enrolled at least half-time in an eligible degree or certificate program, and have a high school diploma, GED, or equivalent, you're good to go. Private loans, however, are more like a picky landlord. They check your credit score, income, and sometimes even require a cosigner. Thirdly, let's talk about interest rates. Federal loans have fixed rates, meaning they stay the same throughout the life of the loan. Private loans, however, can have either fixed or variable rates, which can either work in your favor or against you, depending on market conditions. The fourth difference is repayment options. Federal loans offer multiple repayment plans, including income-driven ones. They also offer a grace period of 6 months after graduation before repayment begins. Private loans, not so much. They typically require you to start making payments while you're still in school, and their repayment plans aren't as flexible. Fifthly, we hit on borrower protections. Federal loans are like a warm, cozy blanket. They offer options like deferment and forbearance, which allow you to temporarily stop or reduce payments if you're facing financial hardship. They also offer loan forgiveness programs. Private loans, however, are more like a chilly winter night. They typically don't offer these protections, so you're on your own. Lastly, let's talk about the big one: default consequences. If you default on a federal loan, the government can garnish your wages or withhold your tax refund. But if you default on a private loan, the lender can sue you, which can lead to a judgment and potentially wage garnishment. Remember, the choice between federal and private loans heavily depends on individual circumstances. Always weigh your options carefully. Navigating the world of student loans can be complex, but with a clear understanding of federal and private loans, it becomes less daunting. We've journeyed through the staggering statistics of student loan debt, where over half of bachelor's degree recipients graduate with student loan debt. We've discovered that federal loans form the majority of outstanding loans, accounting for over 90% of a total national student loan debt that stands at a whopping $1.76 trillion. We've unpacked the intricacies of federal loans, exploring the 4 main types: direct subsidized, direct unsubsidized, grad plus, and parent plus. We've learned that federal loans often have lower rates, more borrower protections, and fixed interest rates, with a default repayment term of 10 years. Then we ventured into the realm of private loans, which make up a smaller part of the student loan market but can have both fixed and variable rates. These loans have stricter borrower requirements and often necessitate a cosigner. We faced off in the showdown between federal and private loans, highlighting the 6 key differences, including borrowing limits, qualification requirements, interest rates, and repayment options. We've seen that federal loans offer more generous in-school repayment options and borrower protections. Now, in wrapping up, We underline the importance of understanding these differences before making a decision. It's about weighing up the pros and cons, considering your unique circumstances, and making an informed choice. Remember, the world of student loans is not a labyrinth designed to trap you, but a system that, when understood, can be navigated successfully. Don't let student loans intimidate you. Arm yourself with knowledge and make informed decisions. Remember, knowledge is power, and with power comes freedom. Thank you for sticking with us in this deep dive into the world of student loans. It's a complex landscape, but with the right knowledge, it's one we can navigate together. Remember, understanding these loans is not just about getting through college. It's about setting the stage for your financial future. So if you found this video helpful, why not pay it forward? Share it with your friends, your family, or anyone you know who might be grappling with the same questions. Let's help each other make informed choices, because when it comes to student loans, knowledge truly is power. And here's another way to empower yourself. Stay tuned to our channel. We're constantly unraveling the knots of personal finance, demystifying complex concepts, and serving them up with a side of wit. So if you haven't already, hit that subscribe button. Let's continue this journey of learning and growing together. Don't forget to hit the subscribe button for more informative and engaging content. Until next time, keep learning, keep growing.